Hello everyone, welcome to another video of Accountancy for You. So today we'll be focusing on accounting ratios from T.S. Kerwal's analysis of financial statements for grade 12. But there will be a small difference. Till now we've been focusing on questions from current ratios. But today one of my friends had asked to explain the last two types of ratios. That's activity ratios and profitability ratios. So we'll be focusing on these two types of ratios for this video and for all the upcoming videos until we cover that portion. So in today's video we'll be doing a basic introduction on activity ratios as well as inventory turnover ratio, which is one among the 6 main types of activity ratios. Right, now what exactly is activity ratio? Activity ratio, it has two other names, that's performance ratio and turnover ratio. And as the name suggests, it's mainly used to find the performance of a company or the turnover of a company or enterprise. That is, it's used to measure how well the resources available to a company have been used. As in, have they been used judiciously? Does it bring about profits? Has it been used efficiently? All these are found out using the activity or turnover ratios. And so it's used to judge the efficiency of use of resources in an enterprise. And for all turnover ratios, one rule applies. That is, the more the ratio, the better it is for the company. Or the more the ratio, the more good it is. So, and another thing that we have to keep in mind while solving questions based on activity ratios is that for all the previous questions in current ratio, we write the answer in the form of a ratio, that is 2:1 or 1:1, based on what we get the answer as. But for these ratios, we can't write it that way. If the answer is 2, instead of writing it as 2:1, we write it as 2 times. And I'll get back to the reason later on. Now the first type of ratio from activity ratios is inventory turnover ratio. So what exactly is our inventory turnover ratio? Let's see. Inventory turnover ratio. Right, what this is, let's see. So inventory turnover ratio is equal to our cost of goods sold by average inventory. Alright, 2 new terms. Well, CGS, we've actually learned it in grade 11 as well. Even average inventory, so let's just go through it. Right, CGS, we know that it's the cost of goods sold, or in other words, cost of revenue from operations, right? So it's the cost throughout the business year, accounting period, the business or the company would have sold goods, and the cost price of all those goods combined is the CGS, alright? So in simple terms, CGS is equal to net sales minus gross profit, alright? And average inventory is equal to our opening inventory plus closing inventory by 2. Alright? So inventories also means stock of a company, the stock. So the opening stock plus closing stock by 2 gives us average inventory. And it's part of the current assets of a company. So CGS, coming back to CGS. I mentioned that it's net sales minus gross profit. Net sales is also equal to our cash sales plus credit sales. Alright, these together form the total sales minus sales returns. Alright, and we know what sales returns are when we sell goods, but then they're returned by the buyer to us, and we have to pay back the money that we got on the sales. That is sales returns, right? So the cash and credit sales, that is the total sales, minus the sales returns gives us the net sales. So even while doing the questions, we've got to be sure that they've given us the net sale value and not just sales. Because if there's a sales value and if there's a sales return, then we know that sales alone won't be equal to net sales. We have to subtract sales return to get our net sales, and it's very important to ensure that is this a net sales amount minus our gross profit. Now remember how in earlier classes we've learned that our CP, or cost price, which is essentially the cost of goods sold, is equal to our selling price minus profit, or is equal to our selling price plus loss. So this is essentially the same thing. Our CGS is equal to our net sales, the total sales value, minus the total profit, the gross profit that we got. That is CGS. Or in other words, in case these two amounts are not given, we have another way of finding CGS. So CGS, that is cost of goods sold, is equal to our opening stock plus net purchases alright plus our direct expenses, right, all these minus closing stock. Okay. Right, so we know what opening stock is, the stock we have at the beginning of the year. Closing stock, the stock we are left with at the end of the year. Net purchases, the total purchases, this is equal to our total purchases, right? Total purchases minus purchase returns. Just like sales returns, the items that we purchased, we could have returned it as well because it might have a defect. So if in case we've returned the goods, then that would not be part of our total purchases. So net purchases, alright? And then direct expenses. Now direct expenses are those expenses that are directly used or connected with the manufacturing of goods. So directly connected with the manufacturing of goods. For example, our wages, the wages we had to pay to get the goods delivered to us, or to get the raw materials delivered to us, wages we had to pay for manufacturing, carriage inward, freight inwards, right, and our factory expenses, and many more. For example, lighting, heating, power, fuel, all these together form the direct expenses. Right, so basically the stock we have in the beginning of the year, along with the additional stock that we got from our purchases, from our net purchases, right, that along with the expenses that we had to incur to get the stock, to get the goods, which is the direct expenses. So along with the direct expenses that the firm had to bear, all these three together forms the cost of all the goods that a company has, right? But we only need cost of goods sold. So these three minus the stock we have remaining with us, which is the unsold stock, gives us the cost of goods sold. And that is the formula for CGS. Right. Now we've covered the two main parts of the inventory turnover ratio. But the question remains, what exactly is inventory turnover ratio? So, inventory turnover ratio aims to determine the efficiency. It's to find out the efficiency with which the inventory is used. Alright? So how efficiently and how well were the inventory or the stock of a company used? Right? Was it wasted? Was it optimally used? So to find out all these, we need to find out the inventory turnover ratio. And another point that I had to say was that, right, now in another way to look at this, inventory turnover ratio, now I told you that I'd tell you the reason why increase in the turnover ratio is always better. So the more the turnover ratio, the better, because if the turnover ratio is more, it indicates that the efficiency with which the company utilizes its resource is more, right? Or it's good. If it's high, it's good, because that means the company has used its resources more efficiently. So, which is always a good sign for the company. So that's why the more the better. It applies for this ratio as well. Another point that we have to note is that here, inventory turnover ratio, not only do we understand the efficiency with which the inventory is used, we understand it because when we find out this ratio, we get the number of times that, like the answer will be in form of times, right? So that actually means that it actually indicates the number of lots in which we bought the goods. And that number of lots, for example, we got the answer to be 12 times. That means we bought the goods, we bought the inventory in 12 lots. And it's always assumed to be equally distributed throughout the year. So if it's 12, it means we bought in 12 lots once every month. If it's one time, then it means we just bought the goods once in a year, and that would be in the beginning of the year, right? Or if the date is specified then. So that is what inventory turnover ratio actually specifies. So it's always better to buy our goods for a company in small lots, right? Because then, since we know that the business environment is really dynamic, it keeps changing, the demand for the goods keep changing, the requirements keep changing. So it's not a good idea to buy huge quantities of goods. But when we buy it in smaller quantities, we can sell it off faster. It affects the profits of a company, and the goods we have with us at a specific point of time can be used more efficiently. So because of that, the higher the ratio, the better. Now it's usually assumed that 12 times is the most optimal ratio that we can get, because as I mentioned, it means that we're buying at least once a year, right? We're buying once a month. So in every month we're buying small lots. And for a company, small lots means it's more efficiently using its resources or inventory. But again, there's another point, that if the inventory turnover ratio is very high, it shows overtrading, which means there's a working capital shortage. And if there's a very low ratio, that means it's inefficient. Or very low inventory turnover ratio means that we're not optimally using our inventory in the company. So these are all the main points that I had to cover in the explanation of inventory turnover ratio. I hope all the points are clear. If you have any doubts, just mention it in the comment section below, and I'll be looking into it. So now, let's start with a few questions. So for inventory turnover ratio in the current textbook, there are three main types of questions you can get. Either it's a direct question where they've given us the values and they've asked us to find the turnover ratio, inventory turnover ratio. Or they could give us the ratio and ask us to find the various components of the ratio. But one other type of question is calculating opening and closing inventory. Alright, so it starts from question 80 on page 3.113 and ends on question 96 on page 3.115, right? So today we'll be mainly focusing on question 80, 81, 82, and 83. So let's get started with question 80. Alright, so question 80 states that from the following details, we've got to find inventory turnover ratio. Cost of revenue from operations, which is CGS, is given 9 lakhs, inventory in the beginning of the year. We have to identify that to be our opening stock or opening inventory. It's given to be 2,50,000. Inventory at the close of the year, 3,50,000. That's our closing inventory has also been given. So this is a really direct question. Now we know that our inventory turnover ratio, I'm just using short forms for now, but you can use the full forms. Inventory turnover ratio is equal to our CGS by average inventory, right? We've been given CGS 9 lakh. Average inventory, remember, it's opening stock, opening inventory plus closing inventory by 2. So equal to 9 lakh by 2,50,000. Now this is 2,50,000 plus 3,50,000. So 2,50,000 plus 3,50,000 by 2, which is equal to 9 lakh by, this together gives us 6 lakh. 6 lakh by 2, 3 lakh, which is equal to 3 times. Right, so the inventory turnover ratio is 3 times. Alright, then question 81. So 3 times, as I mentioned, it shows the number of lots in which we bought the goods. So this states that in a year we bought the goods 3 times. So every 4 years we bought the goods. Right, now question 81. It says that CGS is 5 lakh, purchases is 5,50,000, opening inventory or opening stock is 1 lakh. So CGS is equal to 5 lakh, right? Now they've asked us to find inventory turnover ratio. We have the first part of it, CGS. We have opening inventory, but we don't have closing stock or closing inventory. But we know that CGS is equal to, remember the formula, CGS is equal to our opening stock plus net purchases plus direct expenses minus closing stock, right? So back to the question. CGS is equal to, this is equal to our opening stock, our opening inventory, which is given to us as 1 lakh plus our net purchases. Now, even though they've only mentioned purchases here to be 5,50,000, no other information is given to us about any additional purchases or purchase returns. So that means that the purchase amount given to us is in fact our net purchases, right? So which is 5,50,000. Then, right, that's all the information they've given to us. And direct expenses has not been mentioned. That means we don't have to include any direct expenses in finding the closing stock, or it also means that direct expenses were not borne by the company. And yeah, they haven't disclosed that information to us, so we don't have to use it. Right, and then we have minus our closing. We'll just write direct expenses as well. It's direct expenses 0 and minus our closing stock, our closing inventory, right, which is X. So this means that 5 lakhs, we take all these to the other side, minus 1 lakh, or in other ways, these two together form 6,50,000. So minus 6,50,000 is equal to negative closing inventories. And this forms our closing stock is, well, it is 1,50,000. It's equal to our closing inventories. Right, so now that we got closing stock or closing inventories, we can find our average inventories, right, which is equal to our opening inventories plus closing inventories by 2, which is equal to 1 lakh plus 1,50,000, 2,50,000 by 2. And this gives us, it gives us 1,25,000. Right, so applying this in the ratio. The ratio is equal to CGS by average inventory, right, which is equal to 5 lakh by 1,25,000. So this is equal to 4 times. So that was an easy question too, wasn't it? We just use the formula we know for CGS to find closing stock and use that to find average inventory and substitute that in the ratio to get our final ratio 4 times. Alright, going to the next question. Right, now the next question, question 82. Question 82 states that calculate inventory turnover ratio from the information given. Opening inventory is 50,000, purchases is 3,90,000, revenue from operations, that is net sales, is 6 lakh. Gross profit ratio is 30%. So they've given us a lot of information here. Now we'll pick out the ones that are directly used in the ratio. Opening inventory, that's part of average inventory. Then we need closing inventory and CGS, both of it has not been given to us directly. Now, here though, instead of giving us CGS, instead of giving us our cost of goods sold, they've given us our net sales. Okay, remember how I told you that CGS is equal to net sales minus gross profit? But here they haven't given us gross profit either. They've only given us a gross profit ratio. Now gross profit ratio, this is actually well, it's another type of ratio which we'll cover later on, but for this question I'll just shortly introduce you guys to it. So gross profit ratio is actually equal to our gross profit, right, our gross profit GP by our net sales into 100. So they're saying that this gross profit ratio, that is a GP by net sales in 100, is equal to 30, right? In other words, so in one way we can solve this question is that we know what net sales are. It's given to us. So we substitute that value here, and so we have one variable left in the equation. So we can find gross profit by substituting the value of net sales. And then from net sales, we minus that value. Or another much easier method is that, now we know that out of 100, if net sales were 100, 30% of it is our gross profit. This also implies that CGS is equal to 70% of net sales. Right? If out of sales 30% is profit, then the rest 70% should be the cost price or the cost of goods sold. So this implies CGS is equal to 70 by 100 on our net sales amount, which is 6 lakh. And this gives us CGS to be 4,20,000, right? Yes, 4,20,000. So we have our CGS down. Next, opening inventory is given 50,000, right? And we need our closing stock again. So let's just recollect the formula. CGS is equal to our opening inventory plus our purchases, net purchases, plus our direct expenses minus our closing stock, our closing inventory. We have CGS here, 4,20,000. Opening stock has been given to us as 50,000. Net purchases, well, again, they've only given us purchases amount, but they haven't given any other information related to purchases. So we are taking it to be net purchases, 3,90,000. Direct expenses have not been mentioned, so that ends up being 0. And our closing stock, our closing inventory. Alright, so this means that together this forms, well, it forms, right, 4,40,000. So 4,20,000 minus 4,40,000 gives us closing stock. This implies our closing inventory or stock is equal to 20,000. Right? Now this implies average inventory is equal to 50,000 plus 20,000 by 2. Now we know inventory turnover ratio, right? It's equal to CGS by average inventory, which is equal to CGS has been given to us as 4,20,000 by average inventory, 70,000 by 2, 35,000, which is equal to, right, 12 times. Now this is a very good inventory turnover ratio because, as I mentioned earlier, we're buying stock once every month, which is considered to be efficient and optimal use of resources. Alright, next we'll be doing question 83. Let's read it out. So they've asked us to calculate inventory turnover ratio. Opening inventory is given to us, closing inventory is given to us, purchases have been given, wages have been given, carriage inwards have been given, freight outwards have been given. Remember, so we'll just, alright, before starting with the question, we'll just quickly identify which of these information is actually needed, alright, and which comes under what. So opening inventory, we'll use it to find average inventory. Closing inventory, we use it to find average inventory as well. Purchases. Now, notice here that they haven't given us CGS or net sales or GP. So, purchases can be used to find CGS. Wages is a direct expense, so it comes under CGS. Carriage inwards is another direct expense. It's transportation of goods to our site, to our factory. So, transportation of goods or raw materials. So, that is carriage inwards. It's a direct expense. Freight outwards. Now, that is not a direct expense. Alright, so let's get started. First, we'll find average inventory. Inventory is equal to closing plus opening stock by 2, which is equal to 2 lakh plus 60,000 by 2, which is 1,30,000. Alright, next, CGS is equal to opening stock plus net purchases plus direct expenses minus closing stock. Right? Opening stock is 2 lakh. Net purchase is 4,60,000. Direct expenses, now this is including wages and carriage inward. Wages is 30,000. Carriage inwards is 20,000. Right? Minus our closing stock, our inventory, 60,000. When we solve this, we get CGS to be equal to. Right. So 2 lakh plus 4,60,000, 6,60,000, 6,60,000, 6,90,000, 7,10,000, 7,10,000 minus 60,000 gives us, it gives us 6,50,000. Right? Now to find the turnover ratio, inventory turnover ratio is equal to CGS by average inventory, which is equal to 6,50,000 by our average inventory 1,30,000, which is equal to, it's equal to 5 times. 13 into 5 is 65, so 5 times is the answer to the question. Right, and that's question 83. And the answer to that is 5 times. Right, so I hope that all the concepts, the main basic concepts of inventory turnover ratios have been cleared by these questions. But of course, we'll be doing the rest of the questions later. Right, so I hope all the concepts discussed in today's video is clear. And if you like the video, don't forget to like, share, and subscribe. And if you have any doubts, do let me know in the comment section below. Thank you. Have a nice day.